It's almost like a Lehman moment, in that what happened with Lehman on Friday, when they were in the middle of their situation, they didn't think they had a credit problem. But by Monday, they were bankrupt because of the cascading effects when you stop payments. In their case, it was short-term funding markets that weren't allowing them to roll and get the credit they needed for payments on a Monday. Well, to a large extent, that's the frightening part that's now going through the market, actually, as we talk. And a point I'd add also in this sovereign debt, Adam, is that Russia got out of the U.S. treasuries in 2018, and has primarily went to gold and to a heightened level of liquidity. And it has about $1 trillion of open liquidity, and about 200 to 300 billion is used in short-term funding. That is overnight funding for a lot of the banks or institutions, et cetera, around the world. And every time we have a credit problem, it's usually associated with overnight short-term money funding. This is how the contagion starts. It starts with credit.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart here, welcoming you back for another special interview made all the more important by the current ongoing developments in Ukraine. The world has quickly become a less stable place over the first 2 months of 2022. Financial system stability, especially in the all-important bond market, was eroding at a concerning pace prior to last week. But Russia's recent invasion of Ukraine is serving as an accelerant to the situation. To give us an understanding of the key risks to monitor, we welcome investor and market analyst Gordon Long to the program. Gordon has issued several recent warnings about the credit markets in his latest investor letters, and I'm eager to hear him explain why. Gordon, thank you so much for taking the time today to join us.
Adam, thank you very much for asking me. I appreciate it.
Well, thanks.
Our timing couldn't have been any better, actually.
You know what? You were the man to reach out to, and man, then this weekend happened, and you're right. It just made it even more relevant. So let's dive right in here. I got a lot of specific questions that take into account what's going on right now in Ukraine. But before I ask them, I just want to ask you the question I kick off all of these interviews with, which is, what is your current assessment of the global economy and financial markets?
I'm concerned, but then I'm always concerned when there's risk at stake. But this year, at a highest level, we can say we're in the fourth turning. And if you look at any of the long-term cyclical charts, one of the things that's consistent is we're in about a 3-year window where all of these long-term cycles are reaching bottoms. And of course, then you get into those who've studied the fourth turning. So you get a lot of major social change for whatever reason, and that comes with economic and financial change. And clearly, that's what we're in the midst of. And this is the first time in my lifetime I've been through a lot of market crashes, and I didn't see this kind of geopolitical issues and social unrest I've seen before. So the bottom line is, we're very concerned about 2022. There'll be a lot of money made, but a lot of money lost in it. So just make sure you're paying attention.
Okay, great. And for folks who maybe aren't familiar with the term fourth turning, it is a descriptor of generational cycles that society goes through that are each categorized by certain types of developments. Fourth turning tends to have a lot of upheaval. I actually interviewed one of the two demographers that whose research basically defines the fourth turning, a guy named Neil Howe. If you haven't yet watched that and want to, you can watch that video right here. All right, Gordon. So as I said, we're recording this on Monday, February 28th. Over the weekend, things have really intensified in Ukraine. So Russia made an incursion there on Wednesday night last week, US time. Over the weekend, things basically escalated there. I think it's becoming a more so far at least, a more protracted engagement than maybe a lot of people thought it was going to be. I think a lot of folks thought it was going to be over really quickly. So you have written that we had this very unstable situation developing in the credit markets. I think you referred to them as brittle, and that was pre-Ukraine invasion. And you're saying that the Ukraine invasion is now really adding an awful lot of additional instability to the system. Can you explain why?
It's because of it is centered on Ukraine, but it's more about our policy response that's really shaking the market right now, Adam. And I say ours, this is the whole area of sanctions. We've been doing sanctions for years, at least the US, so I don't think there's anything really new in that regard, nor new to Russia. It's the degree that we've now taken them, and specific that we're now putting sanctions against a central bank, and specifically the Russian central bank, and then second to major banks within Russia, not all of them. And you can see the rubles dropped 50% in Russia here in the weekend. And the last time we had the ruble crash or drop like that, that was the LTCM crisis, and that brought the market down. So I'm not saying that's going to happen. I'm just trying to say the magnitude of doing that, because it's almost like a Lehman moment, in that what happened with Lehman on Friday, when they were in the middle of their situation, they didn't think they had a credit problem. But by Monday, they were bankrupt because of the cascading effects when you stop payments. In their case, it was short-term funding markets that weren't allowing them to roll and get the credit they needed for payments on a Monday. Well, to a large extent, that's the frightening part that's now going through the market, actually, as we talk and all weekend. I'm not saying that it's about crash. Please don't. I'm just trying to say these are symptoms we've seen before, because when you start to put limits on, flows of money stop. You don't know whether you're going to get the money from which bank, because they don't know whether they're tied into what part of the credit flows that are coming out of Russian banks and central banks to kind of net it out. So that's the ripple effect. But the ripple effect is already in areas that in sovereign credit was having problems before this happened. In corporate credit, it's a whole discussion in itself, and soon to evolve in consumer credit.
All right, so if we can, let's kind of pick each of those apart. And first, at a high level, sort of what I hear you saying is the economy is just so hyper connected these days that it's almost impossible to know, if you cut the flows of money in one place, what that ripple effect is going to have on the rest of the system. And it seems like we've now put some pretty substantial blockages in place in the system, or we're scrambling to do that right now in terms of a lot of these Russian sanctions. And we don't really know yet, again, what impact that's going to have and who is exposed to that. So,
precisely.
Yeah, and I'm curious if we may be seeing over the next week or two headlines of hedge funds or pensions or whatnot that were much more exposed than we realized, or maybe even they realized, and that are now kind of waking up to that. So it'd be really interesting to see what happens down there. But you mentioned that there's sort of issues across the credit spectrum here: sovereign debt, corporate debt. There's other types of debt you talk about as well, emerging market bonds, and a few other things. And maybe we could just pick each of those apart briefly. So you said that let's start with the sovereign debt. That's the debt of nations. We have a lot of, certainly over the past couple of decades, many nations have been adding debt at a greater and greater magnitude. I think we could have had a big discussion before what's happened in Ukraine about kind of the global debt overhang. But what was worrying you about the sovereign debt market going into what's just happened with Russia and Ukraine?
We watch credit default swaps for sovereign debt fairly closely. And frankly, sometimes it's just like watching paint dry. There's not much change in it. But over the last 6 months, we've noticed it very much accelerating and increasing. And specifically,
Gordon, sorry to interrupt you, but for folks that don't understand what a credit default swap is, could you just give a brief definition?
Oh, I'm sorry, Adam. Thank you for clarifying that. Yeah, credit default swaps are basically an insurance policy that you take out to protect yourself or your investment from a default from one of the sovereign debts that you might be buying. So the debt of America is U.S. Treasuries. If you've got them and you think there's a risk when you can buy these credit default swaps, they're typically very inexpensive. but to protect you from the possibilities of a default. But they have been increasing, and we've noticed in the last 30 days, and we were just basic discussions of Ukraine. It wasn't a heightened situation. They had really climbed up in last 30, as I said, the last 30 days, and of course in the last week, and with the inflation, have exploded even further. So to give you a perspective on that, that's something that moves very, very little. Russia's credit defaults have surged 70%. They've been cut to junk. Their default rate's now at 6%. Poland is shot up to 65%. So you can understand that's kind of an immediate that's happened here in the last week. But it's spilled over into the Scandinavian countries with Finland and Sweden, because they could be potentially at risk with a NATO expansion or Putin's assessment of a potential NATO expansion there. They're in the 35%, significantly higher. The EU members themselves, usually 5-8% are up in the 15-20%, and what we used to call the peripherals in the 40% range. So they're dramatic. And when those credit defaults grow, it's costing people a lot more money. And we have to understand too that these debts sit on banks around the world with Basel II agreements, and there's something called value at risk. So when the credit is more exposed, it forces banks, irrelevant of actually whether they're involved in this, their banks have to start changing their strategies or adjusting their books automatically for value at risk. This is how the contagion starts. It starts with credit, and then it starts to potentially, and the worrying part right now, and peers, everybody, we're looking at it, is what the collateral that's underlying that. So that's a big part of the problem. And a point I'd add also in this sovereign debt, Adam, is that Russia got out of the U.S. treasuries in 2018, and has primarily went to gold and to a heightened level of liquidity. And it has about $1 trillion of open liquidity, and about 200 to 300 billion is used in short-term funding. That is overnight funding for a lot of the banks or institutions, et cetera, around the world. And every time we have a credit problem, it's usually associated with overnight short-term money funding. And that comes out of things like reverse repos. And I won't get into those technicalities, but that's what's stemming in the sovereign debt.
Okay, so thank you. That's super helpful. And just to process it in my mind here, you're saying that credit issues, I'm going to say credit crises even, they're at the base of them is a lack of liquidity. That liquidity dries up, and then all of a sudden all these people across the system that are dependent upon continued access to credit, they start getting into trouble. And so if we're all of a sudden sort of shutting off the hundreds of billions of dollars that Russia was sort of lending out overnight to lots of banks around the world, they're either going to have to get that money from somewhere else, or they're going to have some liquidity issues. You talked about the credit default swaps all dramatically rising in price relatively recently, and that both just sort of makes credit more expensive for the system that's relying on it.
Very significantly makes it more expensive.
Yeah, and there's a chart you shared in your latest letter here, I'll put up here, but it shows Bloomberg showing how financial conditions, even here in the US, have tightened quickly, really over the past week and a half. So it's not just weaker countries around the world, it's even happening here in the US. There's another chart you put up here from Goldman Sachs showing how kind of the global financial conditions index is tightening as well. Which, what I want to sort of underscore here is that, tightening basically means that credit's becoming more expensive. And when you have a system that's so dependent upon credit, the more expensive it becomes, the sort of less bounty you have left in the system to do other things. And I guess rising credit default swaps too, or maybe just an indication that people are a little bit worried that default risk is now higher. And obviously, if you have a default, well, then you can really start getting some cascades going on here. So am I kind of putting my finger on the right reasons to be concerned about this?
Yes, absolutely, Adam. But I need to caution. I'm saying these are potential issues, and we've seen these before. Don't underestimate that right now the central banks themselves. I can assure you, they have spent most of the weekend and will this week going through how to ensure that the liquidity is maintained. The last time we had, I'll call it a real liquidity shock, was during COVID. And as you saw then, the banks came out, Federal Reserve, with facilities. We actually started buying corporate bonds, for example, with the secondary market corporate credit facility at the time. So the Federal Reserve and the central banks right now have to decide what needs to be done and how it might be done. And that's what everybody's really watching, and the clock's ticking for. And to put it into just a perspective, right now, just in the US, we finance about $1.6 trillion overnight every night. 1.6 trillion. And I suspect it's even much higher in the last few days. So that 200 to 300 billion of Russian money that is in short-term funding is in some central banks. It isn't just us that is funding overnight. A lot of the central banks, EU specifically, are. And so what happens to that? What happens to that capital? And is it available? Because as I say, it's overnight. So you're literally lending short or borrowing short and lending long. So you have to have that money if you're a lender, or you're in trouble. You're on the wrong side of the lending curve.
Okay, right. So the system really is dependent on, or a lot of players in the system are really dependent upon being able to get those funds night after night after night to do what they're doing, or else they get into trouble. So it sounds like you're saying, look, you're not staying up nights right now worrying that the system's going to kind of snarl to a halt tomorrow. You think that the other world central banks are going to find a way to step in and provide that liquidity on an ongoing basis, at least in the near term. But this is a good segue to a question about just the Fed.
And I don't know the form that it'll take, but if the problem is mounting, they will. And maybe I wasn't clear. The issue was they anticipated that the sanctions were coming. They did not believe that it was going to be directed at the central bank of Russia. And as of last Thursday, even Germany was saying we need another 30 days. So when Biden made his speech, he was talking about sanctions. He wasn't talking about that. But Germany changed its position dramatically. It changed its position on NATO, sending military equipment. It did 180 degrees and said the sanctions were a go, as some of the other G7 members said, on central banks. So it's caught the markets flat, the credit markets flat-footed. And that's the adjustment process. And so it's today, tomorrow, it's kind of flowing through the markets. That's why I thought your timing couldn't have been any better.
Yeah, thanks. And specifically that important reversal you're talking about, policy reversal by Germany, that happened, I think, Saturday, right? That happened over this weekend. So it's something that we're still very much in real time, trying to react to here. Okay, so
is the rest of the world trying to figure out, as I said, where is all of that Russian liquidity, and where, how are they going to operate, and are they going to start moving? We get into the whole discussion on the SWIFT system, and will it force them to start moving their money through? There's an alternative, and that's the Chinese have an alternative system. They've been anticipating this sort of thing for a long time, and what everybody's trying to read is, I don't want to get too technical here, but just, is this going to be the catalyst that starts to make things happen faster? And there's been a big movement because the United States has been using these sanctions so consistently. Because remember, the sanctions go not only against the country you're targeting it at, but any country who deals with that country. And so they get caught in it, and they've tried to protect themselves by moving away from the US dollar. And more countries have tried to reduce their currency reserves from the US dollar to other areas. So we get into the euro.
All right. So I'm really glad you just mentioned all that. You mentioned the word SWIFT. If you could just very quickly define for folks what the SWIFT system is, and I'll take a crack at it real quick. It's really how banks send money to each other basically around the world. But if you can talk about the importance of the SWIFT system and the role that it has here as a weapon against Russia here, if you know, by cutting them off from that SWIFT platform.
It's nothing more than, to be simple, a glorified email system is really what it is. But it has tremendous amount of security and confidence between the banks, so you can trust the content as, in fact, money that's being transferred or commitments that are being made. So it's the same. The equivalent would be if you got your email cut off. You couldn't communicate nor to anybody nor anybody to you. And if you're in the middle of a business transaction, how do you go forward? And that's in the bank's case, when money is measured in seconds and milliseconds and days, this is a big deal, because suddenly you're caught on a liquidity problem or what they call a counterparty risk.
Okay, so by cutting Russia off from SWIFT, obviously we isolate them, you know, economically from being able to, you know, send and receive transactions.
But Adam, we as much hurt everybody else around the world as Russia. That's what's missing.
Right. I know one of your concerns, which we'll get into in just a second, is the contagion factor of this, right? Which is we're not just hurting Russia, we're creating kind of dominoes that are going to blow back and hurt a number of other players around here. And I want to get to that in just a second.
Not just because of the contagion in credit. I'm saying that, in fact, it hurts them directly. Any of the players that deal with Russia, even if they have credit, it hurts their whole trade process. And so they start adjusting. They'll start adjusting commodity prices very quickly because of it. That's the point I'm trying to differentiate from credit to the whole buying and supplying in the supply chain of what you take as risk and preparation and order flows.
Great clarification. Thank you. Yes, it does exacerbate some of the credit risk we were talking about, but I was right there with you. Is we're basically interrupting global trade, right? And what I hear you saying is you know, TBD, we're going to find out all the ways in which there are knock-on effects there that we sort of didn't expect from this, and we'll have to react to those. But on a higher level, you know, I think what you're saying is look, you know, the world for a long time, there have been countries around the world that have been trying to figure out how to become less dependent upon the US dollar. It's the world's reserve currency. It's the petrodollar. It's how you pay for oil. And you've had countries like Russia and China and Iran and others that have been trying to create, you know, trade arrangements that settle in other types of currencies. It sounds like you're saying you think this is going to potentially really accelerate that, and that this could be, you know, kind of a catalytical moment for a chunk of the world to really get more serious about coming up with competing systems, both to SWIFT and to trade in non-dollars. Is that all correct?
That is correct. There's almost no doubt that a lot of countries are frustrated with American policy. They don't agree with American policy in some cases, and they're really third parties to this issue, and it's forced them to move more and more away from the dollar. But the problem expands itself, Adam. It's not the US dollar just, it's the euro dollar. And remember, the euro dollar is based on the United States dollar that's being leveraged through the entire global banking system. So we create, you know, the old theory was that we put $1 in our bank account here, the banks can lend out $10. Those days are long gone, but let's just be simple here for a second. One of those dollars goes to a European bank, they lend out $10. But if that done, and it just keeps cascading all around the world, of that debt just keeps growing, all based on $1 that was lent out here in the $10, and one of it went to Europe. And so what happens is, where's the collateral to underpin that in the euro dollar system? So if the dollars start to weaken or there aren't as many dollars out there, there's a whole contraction that is forced to begin to happen. And the underlying part of it is something that, and again, I'll be technical here, called a rehypothecation, where the collateral is not identified and people can't track the collateral. For example, you have a car, you've lent the money, the car is in fact a collateral. Well, if you really track it, that car could be on, figuratively on 30 or 40 people's books as collateral against their loan. And that's what's happening in I'm being very simplistic here, in the euro system, the euro dollar system. And that's why even minor little disruptions here can have such profound impacts and force people to take actions that they don't necessarily want to take. I mentioned earlier something called VAR, value at risk, that are Basel II, Basel III are forced requirements in the lending and banking institutions.
Okay, great. So, for the folks that aren't as familiar with all the technical jargon as you, Gordon, the underlying point that we're making here is that the system is, again, very hyper-connected, and you can have a failure in one node that then triggers all sorts of other repercussions, a bunch of different nodes, and all of a sudden people are having to react to that, and oftentimes making decisions or choices that in a stable world they wouldn't be making, but they kind of have to make that a necessity here. And then the danger, obviously, is that could maybe cascade out of control at some point. So you used a term that I just want to dig into a little bit more with you. In your latest paper, your conclusion was that the world is on the verge of a contraction. I'd love to have you just sort of explain what you mean by that writ large. And then you say, especially if an oil price shock exacerbates inflation. And are you worried about an oil price shock because of Russia potentially, their supply going offline, or are there larger issues around oil that make you zero in on the price shock there?
Well, we really don't know what's going to happen with the supply itself when you get into combat and war situations and they escalate. But excuse me, I actually do. I think oil's trading 115 here as of this morning. It wasn't that long ago. It was $10 and $40, and the explosion we've had in the last couple of years. But I do see the energy complex with some serious issues going forward. But it was here before Ukraine. Our energy, for example, in the United States, we've moved from being an net energy exporter a year and a half ago to now importing between 200 and 500 million barrels a day of oil from Russia. So the dependencies have changed, and of course the flows, and so the disruption is there, and is a major concern that we have. But the question you're asking is a slowdown. Before this happened, we are seeing globally, we've had a tremendous rebound out of COVID, no question about it. But we've pumped literally trillions and trillions, about 30 trillion worldwide into the economy. And when you throw this much money at an economy, you got too many dollars chasing too few goods and a disrupted supply chain. We know the whole story there. But that's peaked, and it's coming off, and we're slowing down. And you can see it in the global PMIs. They're falling at a pretty rapid rate. Earnings is still very good here in America currently, and I expect they won't be too bad for the next quarter or so. But markets price out 6 to 8 months, Adam, as you well know. And what's happening is our PEs, our price to earnings ratios, are so high. There's 10 companies. We used to call the FANGs. Well known, that are the dominant part of all of these indexes, and are all held by passive investment through ETFs. And those PEs are well north of 30, 35. And typically when you start to get slowing, your PEs start to fall down into the 15 range. Well, right now, if you look at the PEs and you take out those big 10, the PEs are running around 18 or 19. So if the PEs and that's with a vast majority of them trading below their 200-day moving average. And so if the PEs need to come down to 15, if you get into a recession, they often drop to 8 or 10, but they need to come down. That means some of these big players with PEs well north of 30 may be taking down to 25, not just on slowing, but also because rates are being brought up by the Federal Reserve. We're anticipating some fairly significant increases potentially over the next 6 months. So that's putting pressure on them. Those PEs start to come down. Even though the earnings are there, the market contracts. And that's what I'm referring to on a contraction that we see coming. Didn't mean to be too technical there or long-winded, but that's the slowing. And this shock we're putting in here compounds the costs associated with that credit that goes into these high-tech companies. They track very, very closely to interest rates and a Federal Reserve balance sheet or reserve central bank balance sheets.
Okay, so we've got the cost of credit looking like it's going to continue becoming more expensive, both from just the tightening program that the Fed already had planned, right? But now we're having all the issues in the overnight lending markets that you were talking about, that's in the rising in the credit default swap rates and stuff like that. So we're seeing credit get more and more expensive, which is going to be a drag, both on asset prices and on economic growth. We've talked in this program past bunch of weeks about how economic growth does seem to be continuing to slow, both in the US and elsewhere in the world. If I could put words in your mouth, Gordon, I would say you probably envision sort of a stagflationary scenario this year. Correct me if I'm wrong, but slowing economic growth, but inflation still remaining protracted. You know, I guess my question where I'm going with all this, Gordon, is looking out into the future now. So we've talked about the general instability of the credit system. You've just talked about why equity prices probably need to come down. We've talked about how what's going on in Ukraine is kind of shaking up the box of risk here, just making things all a little bit more risky. So as you look out across 2022 and maybe a little bit beyond, what are the assets that you think make sense for the average investor to consider here? Which ones do you think may fare well given this type of outlook? And are there any that you just wouldn't touch at all given what you see?
A good question, Adam. I think we've seen gold absolutely explode, or it's pulled back slightly. So the whole area of hard assets are certainly need to be seriously considered. And a lot of people have been in, and some of them are well priced. And so I minister or suggest caution there. But you will see commodity prices with pullbacks, but continue with this inflationary pressures continuing to build. We could be at the beginnings of a commodity super cycle specifically. But to answer the question directly, maybe we missed talking, Adam, about what's going on in corporate debt. And our concept here, our discussion has been in sovereign debt and the global debt structures around the world that underpin it. But in actual fact, I'm more concerned right now with corporate debt, and that gets into treasury bonds indirectly, but the spreads in corporate debt, investment, junk bonds, high yields. And where I'm going on that is that the drop that we're seeing in junk bonds, high yield, that is, has been quite alarming. And
sorry, when you say drop, you mean drop in prices, correct?
It dropped in price, yields going up, spreads getting wider against risk-free, for example, the U.S. Treasury bond. Yes, exactly. So the high yield is dropping, and we have, according to the Bank of International Settlements, 20% of all of the S&P companies now are what they refer to as zombies, and that report was well a year and a half ago. And so by a zombie, what they're referring to is that the companies are not making enough clear profit in discounted free cash flow to actually cover their interest payments. So they're having to borrow to keep the company funded. And that funding is based on the discussions we've had, but associated specifically to corporate bond costs for them to do that. And if they can't get the money, because in the cost of it in the corporate, there's a big problem. Now that's just the high yield. And in the investment grade, the vast majority of them are now CCC, which is one level right on the verge of being junk. And in fact, they have to be investment grade. A lot of covenants are structured in such a way that they can only buy investment grade. So they're questionable. And Moody's and everybody is warning very strongly that they could slip down into junk, which would cause some problems. And the last time we had this, as I mentioned earlier, with COVID shock, the Fed stepped in and started buying all those corporate bonds to make sure they had enough liquidity. And they did that and drove the prices up dramatically on those bonds, took down the yields to allow them to fund themselves. And they started that in June, right after COVID, in something called the second SMCCF. It was a facility that put out. They started it in June. They stopped it in January of last year, 2021, but they sold all of those bonds and ended that here in just the past September. And ever since then, they've been falling fairly significantly. But there's a big drop from there to what we saw just with the impact of a minor COVID shock. And that is itself is probably more of a consequence than some of the discussions I've been labeling here in the sovereign debt is in this corporate. And that gets back to your question. If we have problems there, and if the Fed doesn't step in once again to do something like that, then it starts to almost guarantee a recession. And remember that we're at the end of a 10-year business cycle, one of the longest business cycles we've had because of quantitative easing of bringing demand forward. And you keep bringing it forward, but you create a hole on the other side. And so it's a natural consequence of a demands of a business cycle that it comes to an end. And that's what we're kind of fighting. And we put all this money into the system, have extended it, but it's a natural phenomenon for it to fall off. And so if we have this other shock, as I just described in corporates, it'll accelerate that. And if we have a recession, especially with the Fed raising rates now, if you can believe it, it's a potential tremendous policy mistake, potentially. That's what's worrying for going forward. And so it begs questions of whether there's investments in the bond market. It begs questions of what's happening with the dollar, with the twin deficits and what the dollar might do. There could be some significant weakness in the dollar. So what you buy, if it's dollar denominated in itself, is problematic. The shift, even as simple, Adam, as moving from growth to value, are consequences. We have 9 different areas that we believe are consequences of this sort of thing that we publish as potential. I hate to be negative on this, but we're talking about a situation here that is just exploding here in the last 10 days.
That's okay, and you're not that dissimilar from a lot of guests we've had on this program here. So don't.
I'm glad to hear that. I hate to be being too negative.
Well, really, we're not looking for people.
But Adam,
to be
I
negative.
need to stress too that these create opportunities. The Chinese symbol of crisis is danger, but at the same time opportunity. So if you're really studying this and you're paying attention, not only can you protect your wealth, and I strongly suggest that people just don't leave it to others, get involved. But there's a chance, if you can do it well and common sense, to do really well in this period. But to just ignore it and not pay attention, I caution you.
All right. Well, look, there's a zillion questions that even just your last answer triggered in me. We don't have time to go through all of them, but I'll try to kind of land the plane here on the original topic I asked you, which was, what are the assets that you are more favorable on now? It sounds like you've said golden hard assets seem to make sense. I'll interpret what you just said there about corporate and high yield debt, which is you think there's a lot of risk in that space right now. So you probably wouldn't be touching those. It sounds like if things continue to degrade there and we tip into recession, well, there's a lot of equities that are probably not going to do very well, right? My assumption is we'd have some market correction along with that recession. And one could say, hey, just sort of stay away from stocks in general, but maybe there are sectors that you think look good. I don't know. So when you talk about opportunity, let me ask it maybe differently. What are the opportunities that you're keeping your eye out for here that if you see develop would make you want to deploy capital?
Energy, the entire energy structure. And this isn't just about the Ukraine and Russia. It has to do with the imbalances that we now have. I mentioned earlier with the United States becoming an importer, but this tremendous world movement of going from based on climate change, of going to green energy and right into ESG and the other kinds of supporting movements that are going on. And put it into perspective, Mark Carney at the COP, a conference in Glasgow, this was the major climate, identified 130 trillion. Let me repeat that, 130 trillion of committed money around the world. He documents exactly what all these players have committed to help fund movements and shifts to green energy. There's tremendous problems because of a lack of funding in fossils and carbon-based as we get away from carbon-based. On the other hand, there's exploding money going into new areas that are going to be, I believe, huge, absolutely huge. And it isn't just electric volt, and it isn't just solar and wind. I mean, a lot of those are fully priced. I'm talking about new fuel cells such as hydrogen, the magnitude of using hydrogen, how we can generate electricity, and new tools of doing that, of elements of nuclear that people are totally unfamiliar with. It just goes on. And that's a huge amount of money looking for a lot of investments. So where there's problems, there's also tremendous opportunities.
Great.
And then the commodities infrastructure that supports a lot of those new kinds of investments, cobalt, lithium, and the list just goes on. Because they're very exciting time for us, Adam. Absolutely.
Yeah, and it sounds like what you're saying there, even if the economy kind of goes into recession in the near term, there's so much committed capital for that sector that sector may still just have a big tailwind, almost irrespective of what the general economy is doing. All right, Gordon. And then, so as we begin to wrap up here, it's not lost on me that I didn't have a chance to ask you in this time about financial repression, which is a topic that you are a very leading authority on, and that provides kind of even greater context to what's happening on the macro level here. And I hate to tease people, but I think we're going to have to leave that for the next time we have you on the channel here. But I'll let you say anything briefly about that if you like, just to sort of whet people's appetite. And if you can, in your answer too, just if there's anything else we haven't talked about that you think should be on the mind of just the average investor who's watching this video, who is trying to be a prudent steward of their wealth through a lot of the tumult that you've just predicted is ahead, please feel free to share that counsel as well.
Thank you very much, Adam. Yeah, I've done a lot of work on financial repression over the years, and what I would suggest to people is it's always been about low negative real interest rates, allowing you to really, for the government to get out from under their debt. It's a proven macroprudential strategy, and it worked at the end of the Second World War. It's worked a number of times, and it's being implemented now, especially with inflation that high, and that's why it's being pushed. But I would challenge people to understand this whole movement to green and green energy is actually another form of financial repression using regulatories. And we get into things like carbon taxes, carbon credits, and carbon offsets that are now trading at phenomenal kinds of dollars. So there's new markets people haven't even heard of that are now appearing on the scene. I would advise everybody that's out there to really take advantage of these opportunities. They don't come along once in a lifetime. They're dangerous. Clearly, some of my comments have suggested dangers there. But on the other hand, I've been in this business a long time. I've never seen better opportunities around the world than I'm currently seeing right now. And it's a matter of applying this capital very carefully and getting people who truly understand what's going on. Too many people, just the last point I make, Adam, have just bought ETFs. And there's nothing wrong with those if you're in a growth environment, in a growth area. And because we've been putting so much money out, they've been almost a no-brainer. And all ETFs went up. But if they have a problem, and I mentioned the top 10 kinds of companies, then ETFs and passive are not the way to go. You need, so I'll call it stock pickers. That's what we're moving into. We're moving into an era, in my mind, of stock picking, which is kind of went by the way. Bought an ETF, you made money for the last 5 or 6 years. I think that's changing.
All right, Gordon. The financial advisors that Wealthion endorses and refers people to are going to have to send you their commission check in the mail because you've just done a phenomenal commercial for them. And you're not the first expert on this channel recently to talk about the fact that we are switching from an era of passive investing to where you're now going to have to become very actively engaged and do all the old due diligence that, traditionally investors had to do to pick out the gems from all the stinkers out there. So anyways, thank you so much, folks. If you would like to hear Gordon come back on this program and really dive deeply into the mechanics of how financial repression works, just let me know in the comments section below. But otherwise, Gordon, for people that have enjoyed this conversation, maybe enjoyed meeting you for the first time on this video, where can they go to learn more about you and your work?
Oh, thank you very much, Adam. Yes, we have a website called MATASII, MATASII.com. We have free videos, free newsletters, and we track all the things we've been talking about on a subscription basis, but as I said, a lot of free services too. And we welcome anybody to join us at any time.
Fantastic. And when we edit this, Gordon, we'll put up the URL there on the screen. Well, Gordon, thank you so much for watching, folks. If you'd like to see more great minds on this program like Gordon Long, please support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Gordon, thank you so much for joining us today, especially with everything swirling in the world the way that it is right now. Thanks for taking the time to join us. Everybody else, thanks for watching.
Thank you, Adam.